So getting out of debt can be easier than you think. And today, I'm going to teach you how to use debt to create passive income. Now, stick to the end, and I'll share with you the story of how one of my clients was able to use this debt to their advantage. All right, so number one, let's just start with what debt is and versus using this for passive income. Now, debt, many people talk about debt. They'll say, well, that's just getting a loan, right? That's where I borrow money to buy a car, credit cards, buying a house, whatever, that's debt. They think about money that's something you owe. That's true, but I want you to understand this, is that true debt from an accounting perspective, yes, the little tax accountant that we talk about here, the accountant perspective will say that debt is actually negative equity. It's when you have something that you owe more money on than it's worth. So have you ever been upside down in your car before? You ever been in a situation where that car, you owe more money on it than what it's worth? Which many of us have been. If you have a car at all, that's pretty common, right? Maybe it's worth $20,000, but you owe $30,000. You're saying, crap, now I'm $10,000 in debt. That negative equity is the debt. Now, if you have a house, for example, now let's just say that house, you owe $300,000, but it's worth $400,000. Well, guess what? Many people say, well, I have $300,000 of debt. No, you don't. You have a $300,000 liability, but you do have $100,000 of equity, right? Because it's worth $100,000 more than what you owe on it. Therefore, you don't have debt. Understand that debt and equity are in opposition to each other. You can't have one without the other. So if you have equity, that means you have no debt. So if you can sell off all your assets and pay off all those loans, you are technically debt-free. Now, I talk about this because many people get all confused about debt. We're going to talk about debt from the traditional way people are talking about, which is using borrowed money. It could be borrowed from assets. And in fact, if you're going to do that, we're going to talk about in just a second how to do it right. Now, I want to talk about passive income. What is that? Well, passive income is where your money works for you without you having to work for that money. This is where you're not working your 9 to 5 or 9 to 9 job, depending on how many hours you work. This is actually money that works for you even while you sleep. So the Warren Buffett quote says this. It says, if you don't make money while you sleep, you'll have to keep making money until you die. We don't want that, right? We want that passive income coming in all the time. So if we're going to use debt, why not use it for creating real passive income freedom in your life? But you got to use it wisely. One thing I tell people all the time is don't fear debt. Don't be scared of it. It's nothing to be scared of. Don't fear it. Fear is an emotion of scarcity. Scarcity drives away money. You want to have an abundance perspective when it comes to money. So understand that debt is a tool. It can either be good or bad depending on how you use it. Now, if you're a horrible spender, you need Spenders Anonymous, you're sitting around that circle saying, I can't stop spending on Gucci or whatever you spend money on, or Apple products, I don't know. But if you're a spendaholic, debt is not for you. Don't even continue playing this video. You just stop right now, okay? Now, if you're a saver, you might think debt is scary because debt is always scary to savers, right? You can never have debt. If you're a Dave Ramsey fan, debt is the most evil thing in the world. It's stupid with a capital O-O and stupid, as Dave Ramsey would say, right? No, we're talking about those of you that are wise stewards of your money. Those of you that know that this can be dangerous, but it can also work in your favor. That's how you know. How do you know you're using it right? Is simply this. When whatever your passive income you're creating with that debt exceeds the payment, and in my opinion, at least far exceeds the payment, that is good. Give you an example. When I was first starting out a business 15 plus years ago, I remember I went to the bank and got an SBA loan. Now, SBA loans are known to have very flexible terms, lower payments for the money you're getting. It was a $25,000 loan that I was paying, after I pulled it out, $130 a month. Now, if you're in business, and any business owner would know this, if you're in business and you can't take 25 grand to make at least $130 a month, you shouldn't be in business. You should just go back working your W-2 job. But that's not what we did. I said, hey, 130 bucks a month is amazing because I know I can make at least $1,000, $2,000 plus dollars a month using that 25,000. And that's what I did. In that situation, debt can be good. Many people use it for student loans. I mean, if debt were so evil, why do people keep getting student loans, right? Why do people do that? Why do you get a mortgage in the first place? Because you know that you can make more with it than the payment, right? That's what you're doing. Just like if you get a student loan, you're hoping that your job is going to make more than what the payment is going to be. That's not always true nowadays, is it? Because sometimes you try to get those student loans and maybe that job, that entry-level job, just sucks. But we got to know how to do it right. So again, the real concept here, the real principle is How can we make sure that the payments that you're earning from your passive income exceed your debt payments? So what are smart uses of debt? Usually, if you're going to use something that has very flexible terms. Things like using a mortgage, for example. Now, someone might say, why would you risk your house? Don't do that. It's scary. Halloween. No, it's not like that, guys. Like really, when you're using this, it's really in a way that is going to create more income than that. So for example, I had a client that same thing. He's like, wait, I can't use debt. I cannot use debt on my house. That's horrible. And I said, that's fine. You don't have to. You could do it the slow way. You can just keep saving and saving. But you have this asset here. And really remember, you're not in debt because there's still equity there. We don't pull out every dollar out of your house. We still leave 20% in there in case markets go down or you have to sell the house. You still have money in there. But if we pull out up to 80% of your equity, guess what? We get access to $250,000 of your money. Even better, because we were able to refinance and get his payment lower, he was actually able to get that $250,000 out of his house for no extra payment. It was the same payment as he was paying today. It's like getting $250,000 for free. No extra payment at all. So he took that $250,000. He then used that to invest in passive investments, specifically in real estate. Many times I talk to people that are nervous about debt. And they'll say, yeah, but what do I invest in? Best thing, if you're going to pull it out of equity from your home, why not put it in real estate in somebody else's home or into a rental property or something like that? So that's what he did. His income that he's getting was now over $2,000 a month. So guys, what's even cooler about that is that not only was he able to get equity out of the house and do it with no extra payment coming out, but that passive income he was receiving was now able to pay for his mortgage payment. He was essentially able to live in his house mortgage free because that passive income was now paying his mortgage payment for him. All those other properties were paying that. That doesn't happen for most people. Most people are so desperate to pay off their house that they'll just go and they'll keep paying and paying and paying for 30 years, 20 or 30 years, hoping that finally they'll be debt free. I'll tell you, let me project your future for you. Those people that eventually get to that point or very close to paying off their house and they're almost completely debt free or are completely debt free, they come back to us saying, hey, we don't have enough money now. How do we create passive income? I'll say, your house that you just paid off. That's a great place to start. If you don't have savings, that's the next best place you can go to that you can create leverage. Again, this is the key thing. Your payment needs to be much lower than the income you're earning. That's how we determine when it's going to be good. Now, there are certain types of loans I don't recommend using. I don't generally recommend using a credit card. Why? Because the payments are really hard to beat. If you try to get a $10,000 credit card, for example, it's not too uncommon to have to pay at least $200 a month. To make $200 a month in an investment that's $10,000, you have to make a 24% rate of return or more. For the most part, that's pretty unrealistic. You're not going to get that in good, solid passive income investments. Most people have to gamble with their money, and that's not safe. We don't recommend that. Also, what's not smart to do, many people ask me, should I use my 401k? Maybe not, because if you use that 401k, the same thing happens. If you pull out $50,000, which is the max you can borrow from a 401k, $50,000 will charge you out of your paycheck, and they have to take it out every single paycheck. It's going to cost you about $900 a month. So again, you got to make at least 22% on your money just to make the payment. So I don't recommend that. Now, sometimes people try to use auto loans. Don't necessarily recommend that either. Again, you want low payments. So if you're going to use debt, generally I'm going to recommend the kind of debt I'm going to use is something that allows you to have a very low payment for the money you're pulling out. Generally speaking, that's home equity. One other example that this worked for, I had a client who had $1 million saved up, and he said, hey Chris, I want to use this money to try to create passive income because my financial advisor says I can only make $30,000 a year off of this. That's all I can pull off. Imagine you're a millionaire and you can only pull out $30,000 a year. You're living below the poverty level, aren't you? So we said, let's do that. Now, as he caught the vision, he says, Chris, I've also got some equity in my home. Can I use that? I said, yes, you could. So he got some equity out of his home. Guess what? Between that, he got a few $100,000 out of his home plus the $1 million. It generated for him $11,000 a month. That's $130,000 a year, not $30,000 a year. He made $100,000 more because he was able to use leverage savings and his equity to get him out of the rat race right now. So here's the key, guys. If you're going to use debt, use it wisely. If you're going to create passive income, make sure it's going into real, tangible assets that produce real, consistent, boring, awesome cash flow. That's the key. Make sure that the passive income far exceeds your payment. Now guys, if you like this video, check out Is Passive Income a Myth right now.